We're ready to move on to receivables. And what's going to happen from here to the rest of the semester is we basically walk our way down the balance sheet. So we've already done inventory. So the next item that we're going to talk about is receivables, and then we'll do long-term assets and liabilities and stockholders' equity. So we're going to start with receivables. This really goes back to the idea of accrual accounting. Remember that we have accrual accounting. It's not cash-based. So the opposite of accrual is cash-based. So we're not that, which means that revenue recognition principle is that our revenue is recognized when it's earned, kind of when your product is delivered or the service is performed, depending on if you're a retailer or a service organization. The whole reason we have accounts receivable is because of that revenue recognition principle, because I'll send the product out on Amazon and I might collect the cash later, or I might repair your furnace now and send you a bill. And so because there's that timing difference, that's why we have an account receivable. Two words that sound the same but have very different meanings in accounting is we can realize a sale and we can recognize a sale. Realize is when you get the cash, and recognize is when you make the journal entry, revenue journal entry. Really goes to expenses too, but you talk about it mostly with revenue. And another way to say that is it's when you book it or record it as revenue. You normally, with an account receivable, you're going to recognize the revenue when the product is delivered, but you're going to realize it when the customer actually pays you. With that in mind, let's talk about our accounts receivables. We really have two parts to the accounts receivable, and what we've talked about so far is what we really call the control account, and that's your general ledger account. In that, you have your total value of accounts receivable. So that's got your total in it. And that's all fine and dandy when we do our balance sheet, but during the year, if Joe Schmo calls and says, hey, I sent in that payment, didn't you record it? You need to look up what Joe Schmo did. That's what our subsidiary accounts do. This has little accounts, like T accounts, for each customer. That's how we keep track of each customer's account. So again, we can send out bills at the end of the month. We know who has paid us and who still owes us. So a subsidiary is just a breakdown of the control account. And the sum of the subsidiary accounts better equal that control account. Otherwise, I made a mistake. So accounts receivable are what people owe us. While we hope that everybody pays us, we know in real life some people aren't going to pay us. And so we know there's some uncollectibles in that. Either they get mad, they move, they declare bankruptcy. For some reason, we really don't expect to collect all our accounts receivable. And we don't know who's going to default, because if we did, we wouldn't do the service for them or send out the goods. But we know some of those people won't pay. Remember, an asset has an expected future economic benefit. If we make an account receivable and we don't expect it to get paid off, it should not show up as an asset. We're going to record these uncollectibles, but we don't really know who they are. First method you can use is the direct write-off method. That is not GAAP. We don't use it. The book spends way too much time talking about it. We're going to ignore that because you're really not supposed to use that. Instead, what we want to do is we want to estimate our uncollectibles. We want to do that because, again, what our asset value should be is it should equal the expected future cash flows for the company. I think we might have called them benefits. We want to make sure that our accounts receivable aren't overstated. So we're going to estimate. And one of the things we'll learn from kind of this chapter forward is we actually, in those financial statements, have a whole lot of estimates. Every number on there isn't the truth. We need some evidence to show that it's a reasonable estimate, but a lot of the numbers that we show really are estimates. So we're going to estimate those. We really don't know who's going to default, but we just come up with some number, and we want to, again, we want to reduce our accounts receivable by that amount. We don't expect to collect it. It's not an expected future cash flow. So we're going to create a contra account, a contra ancestor account. Remember, a contra account is like accumulated depreciation. We've talked about a little bit. So that contra account is an account that reduces the asset. And the asset that we're reducing here is accounts receivable. The name of that goes by lots of names, but it usually starts with the word allowance. And the one we're going to use is allowance for doubtful accounts. Accountants aren't too creative. It's what we're thinking might be a doubtful account. We're not saying they're not going to pay, but it's doubtful that we get all that money. The other side of that then is we want an expense. And remember, in our matching principle, you want your expenses kind of in the year of the associated sale. So we want to make sure that we expense what we don't think we're going to collect in the year that we provided the service or delivered the products. We want those to match. So we're going to have something that we're going to call bad debt expense. We want that in the year the sale is made, and not in the year that the people don't pay us. That means I'm going to have an adjusting journal entry that I'm going to make. This one I usually don't do monthly. I just wait till the end of the year. The accounts we use are always the same, and they always go in the same order. So what we're going to debit, expenses, we want to increase an expense. To increase an expense, we debit it. So we're going to have this bad debt expense, and we want to increase this allowance, and this is kind of a double negative. The allowance reduces an asset. So to reduce an asset and increase the allowance, I have to credit it. First year of operation, I just estimate that $25,000 of the accounts receivable will not be collected. We'll talk a little bit more in the next video about where that $25,000 comes from. What kinds of accounts are those? The easiest one is bad debt expense, and make sure you put that word expense on there, is an expense. That allowance for doubtful accounts, and you can abbreviate it DA if you want. That's a contra asset account. So this one goes on the income statement. This one goes on the balance sheet. So the other question is, well, which account is closed? Well, we close all accounts on which statement? Hopefully you said the income statement. Bad debt expense is closed. The allowance for doubtful accounts stays open from year to year to year. That's going to make a difference when we get to the next video. How does that show up on your balance sheet? I'm going to make this balance sheet because an expense is just going to show up as an expense on our income statement. So that's not interesting. We're going to have our accounts receivable. That's $300,000. And that's just give it up here. We're going to subtract out our allowance for doubtful accounts. That's $25,000 here. And remember, this is a debit, so that's a credit, so that's going to subtract. So we're going to show net accounts receivable, and sometimes they call it AR net instead, of 275. And remember, net is always less than gross. So the net number has to be littler, otherwise you messed up somewhere along the way. So that's how you show it on the financial statements. That's what we mean by a contra asset. It's on the balance sheet, in the assets, right underneath accounts receivable, and it adjusts your accounts receivable.